Welcome to the Market Update Desk, powered by Mortgage One by Scott Riley. It's January 25th. And wow, after a pretty slow data set of information earlier in the week, got a whole bunch coming out today. So busy, busy, busy. We've been prepping for the report here. Senior analyst Mr. Gibson got pretty busy this morning. So let's go through this and power through it. So yesterday, the 5-year auction, which we've been talking about, was met with unfortunately pretty weak demand, and the bond market sold off in response towards the last hour and a half of the day. Later this afternoon, we're going to be getting a roughly $40 billion auction of 7-year treasuries, which need to be absorbed. We'll see how that one goes. Helping bonds this morning were comments from the European Central Bank President, Christine Lagarde, who reiterated that she believes the first ECB rate cut could happen this summer. And she's also talking about slower growth, moderating inflation, and easing wage growth. All fantastic things. We're starting to see that here in the United States, and now we're starting to see it internationally. The other item we got out today that we're going to spend some time on is last year's first look at fourth quarter GDP. There was a strong pace of consumer spending that helped drive GDP growth, along with some very interesting things, specifically increased government spending from the state and local government. Those increased 3.7%. Federal spending increased 2.5%. So the first read of Q4 GDP showed that we grew at a pretty blistering pace, 3.3% annualized, which is going to be interesting to see where we go from here. Within the GDP report is also the quarterly personal consumption expenditure report, and shows how much inflation rose from Q4 22 to Q4 23. That figure came in at 1.5% versus the expected 2.2%. And without it in GDP, that would have come in at 2.6% instead of the 3.3, which would have been closer to the estimate of what the market was looking for, 2%. So we had higher GDP than expected, which put pressure on bonds. But because of the lower than expected inflation, we're getting a little bit of bounce from it, actually. Core PCE is also reported on a quarterly basis within the report, and which is the Fed's main focus as it strips out food and energy because they're more volatile. And that remained at 2%, right in line with what the Fed's been harping at and chirping, the 2% inflation rate. So, wow, we're right there. An interesting thing came out yesterday regarding a program that came about last year from the banking crisis called the Bank Term Funding Program, and that's going to come to an end soon. The Federal Reserve on Wednesday announced that the Bank Term Funding Program, or the BTFP, will cease making new loans as scheduled on March 11th. The program will continue to make loans until that time and is available as a source of liquidity for eligible banking institutions. Now, during the stress of last spring from the banking crisis, this program helped assure stability in the banking system and provided support for the economy. After March 11th, though, banks are going to go back, or other depositories are going to go back to using the readily available discount window for liquidity needs. So there's going to be items still there. Now, another big report today were new home sales. It came in better than expected. Not a big surprise there. So the new home sales, which measures signed contracts on new homes, rose 8% in December to a 664,000 unit annualized pace and was revised from 615,000. Year over year, sales are up 4.4%. There were 453,000 new homes for sale at the end of December. At the current pace of sales, that means there's an 8.2 months of supply, which is down from 9.2. That's going to be the headline on the news, unfortunately, until you really understand it. Susie Orman's going to probably harp on that. But however, only 81,000 of those are completed. When you look at pace of sales versus homes that are completed or the available supply, there's only 1.46 months of inventory. So that's going to be the more important number to look at. Initial jobless claims, which measures individuals filing for unemployment benefits the first time, rose 25,000 from 214,000, coming off the lowest levels that we'd seen in a long time after the holidays. Continuing claims, or those that receive ongoing benefits, rose by 27,000 to 1.833. Peter Vukbar, a very notarized economist, had some very important thoughts on why claims have been stubbornly low. After reading the story from Anna Wong and Eliza Winger, two economists at Bloomberg, it's less clear on what's going on with this very low level of initial claims. They post that we don't think the jobless claims data should be taken at face value. Shocking there. Our analyst finds claims currently are suppressed by historically low percentage of unemployment persons applying for benefits due to low eligibility rate, combined with the lower income coverage ratio, meaning how much they're getting from unemployment. The low eligibility rate combined with the coverage rate for benefits due to inflation, if these factors are remained similar to levels before past recessions, non-seasonally adjusted continuing claims would have been about 500,000 higher. Big difference. That would have had big effects on the bond market. Durable goods order is the last big one that came in today. That came in much worse at much worse than the 1.1% rise expected because it was flat. So that was a benefit to the bond market. Core durable goods orders rose 0.3%, which was a little bit better than the 1/10 expected. Today, we're seeing mortgage-backed securities up 13 basis points, 10-year Treasury down 3 basis points to hitting 4.15. So even though we had some numbers that initially would have hurt the market, once we go deeper into it, we're seeing things that are helping the market. On deck tomorrow is the big one. PCE's coming out, and we're looking forward to it. Hopefully you find this of value. Give us a like, share, give us a call if you need anything, 616-293-2189. Take care.